Our first session is quite timely and very important, actually, after everything that has been happening in the past year in our industry, and it's related to risk. We have two risk experts here today from AON, Lauren Hendricks and Benjamin Peach, who will teach us today how to make better decisions regarding risk in the Web3 space. I am sure they will be sharing very, very insightful things with you and their expertise. So I do not take any of their time. Please welcome them on the floor.
Hi, everyone. We are thrilled with Benjamin to be here and to be the first on the stage to open this conference. And what a better way to start the conference than talking about a lovely topic, which is insurance. So let me ask you a question. Who thinks insurance can be boring sometimes? Yeah, that's what I thought. So let me tell you a story about insurance. You see, over 300 years ago, two men were sitting in a pub in London, and one of them wanted to send his ship out to sea to benefit from from the riches of the spice trade. His name was Tom, but Tom knew the risk: pirates, storms, mutiny. So how could he take all this risk on his shoulder? So with his friend William, they came up with an idea: transfer the risk to a third party by paying a premium, an annual premium. So should the ship sink, they would get indemnified and can continue their business. But should the ship return, the third party would keep the premium. So the third party would get rich. And that was the beginning of insurance, the inception of insurance. So after 300 years, in 2023, what has changed? Not much. You're still paying an amount of money to a third party, which is an insurer, to transfer the risk to him. You still need to cover your risk. That hasn't been changed. The only thing that has maybe changed is the risk itself. So the pirates became hackers, storms became market fluctuation, and mutiny became your own people or third party trying to steal your own asset or the asset of your clients. So why am I telling you this story? I tend to think that at Aon, we are a little bit like William, the friend of Tom, the guy who understands the risk, your activity, and the inherent risk. So you could think that Aon, being a traditional insurance broker, belongs to the old world. But I can tell you that since 2013, we've been committed to the space for three main reasons. The first one is because we are passionate about innovation that enable us to reinvent insurance on a daily basis. We are also challenged. We like the challenge. We like to challenge ourselves to keep up with the fast evolving pace of your industry. And the third one is because we want to differentiate ourselves by remaining the most advanced broker in the digital asset space. So 10 years after, where are we? We are 60 people dedicated to digital assets. Oh, there was a slide. Okay. We have 60 dedicated professionals to digital asset space. We internalized knowledge with risk consulting. We also developed dedicated wording, dedicated capacities on different markets, London and Bermuda. And we are the most advanced broker by being the first to secure 3.5 billion insurance capacity dedicated on the digital space. But to give you more details on our journey so far, please welcome on the stage Ben Peach.
Thanks, Laurent. We don't have the clients listed here above. So basically, we started out our digital asset practice in 2013. And Coinbase came to Aon and said, we need certain risk transfer solutions on our custody solution. We're holding a significant amount of client assets, and we need the insurance market to take on some of this risk so we can scale our company and look to ultimately raise more equity rounds, debt rounds, and to IPO eventually. So this was a brand new concept for the insurance market, so Aon really had to take Coinbase under the wing, talk to a load of different markets through Lloyd's of London and also company markets to really understand what are crypto wallets, what are private keys, how do you custody Bitcoin and Ether securely? And really in 2013, it was pretty rudimentary. We didn't have multi-party computation wallets. We had very, very rudimental multi-signature wallets. So really at this stage, it was a very risk-on piece of insurance for these old school UK insurers. But really, since then, we've really grown our client base. We work notably with some of the biggest brands within the space, such as Robinhood, Galaxy Digital. We've worked with Anchorage in the past, and many other kind of wallet-as-a-service providers and custodians globally across the world, to now offering a whole new range of different products. That's cyber liability, crime, D&O, and we also support our clients in the merger and acquisition space and IPO space when they're looking to make the big transactional liability jumps too. And here are some of the companies we've worked with. You can see quite a lot of Bitcoin miners there too, which we'll move on to in a little minute. So when we're looking at the type of products and solutions and almost services that Aon provides, this box really captures the most popular ones. And we're going to go into a few of these little products in a little bit more detail closer to the time with Laurent later on. But really, when you look at who we serve, this really encapsulates a lot of the different variations of businesses acting within this sector at the moment. So D&O, very, very common. Most crypto companies will usually purchase this for their directors and officers, those who sit on the board and have non-executive director positions. The cyber and tech E&O is very, very popular for technology as a service provider. So if you have a wallet as a service, you're creating smart contracts for other type of businesses, you're going to probably want to purchase this kind of coverage to mitigate like a huge liability claim if that technology was to go wrong. I've spoken about the transactional risk space, but as we've seen, Coinbase went public a few years ago. Robinhood went public on their own platform. And when you're doing these type of activities, and you're one of the first few crypto companies to do an IPO, guess what? People are going to come and sue you for various different reasons. So it's always good to have these type of IPO and M&A SPAC deals in place there. Crime, specie, and custody is by far the most popular type of crypto insurance product in the marketplace. This is well into the billions, and we're going to go into a little bit more detail about what that covers, but really any company that's custodying assets on behalf of clients and customers, or even their own assets, will look to buy this type of product. Property has absolutely skyrocketed at the moment with so many public Bitcoin miners needing property insurance. What happens if a flood or a natural disaster affects your mining facility and you have a business interruption claim where you're losing precious Bitcoin mining rewards? You're going to buy property insurance to really protect your business, okay? And then lastly, looking at kind of like the bottom, we have a number of different services, whether it's our actuaries who build self-captive solutions for insurance companies, whether it's our cyber and blockchain security team who actually pen test, stress test Web3 software code, or our kind of new solution development where I sit in our advisory service. We will also look at tailor-making very specific insurance policies for our clients too. So, moving on. Going to pass it over to Laurent.
Thanks, Ben. So the industry, Ben talked about like the type of clients we serve. So we can divide them into 5 different types: exchanges, custodian, trading liquidity, hardware and software provider, and traditional finance. But the most interesting thing here on this slide is clearly the risk associated to those activities. So as you see, it's quite similar to the traditional industry. You still need to cover your activity against like data breach, reputation, technology failure, professional services outage, theft of asset, and so on, business interruption as well. So how do we mitigate those risks, and what are the insurance products available to transfer the risk? So we will deep dive into 3 different type of risk transfer solution. The first one being the directors and officer liability, so management liability, which covers mainly the mismanagement and wrongful act. Custody solution, as mentioned by Ben, is one of our key product covering the theft of assets. And the technological errors and omission and slashing cyber covers professional services and technological services outage and data breach. So let's start with the DNO, Directors and Officer Liability. What do we cover? If we take my example from the beginning with the ship, we are covering the captain of the ship by protecting his personal liability from any claim that can rise from any decision he takes during the time is at the bar, is like behind the steering wheel. So who's insured? Actually, all the people that take decision on behalf of the company. And who can claim? Basically, all the people that has partnership or relationship with the company. And what are the things we cover with this? It's mainly defense cost, reputation cost, and mitigation cost. Also indemnity cost in some situation. But it's quite it's a good theory, but let's take an example. Let's say like a lot of companies need to comply with KYC, AML regulation, and they need to put in place concrete measures to be compliant with those regulations. But what if they are not compliant and they fail to comply? Regulators can file inflict fine and penalties, and therefore the company would suffer a loss. And the shareholders can claim against the mismanagement from the executive board of directors. So in that case, we would have the shareholders of the company claiming against the directors, and we would cover defense costs, reputation costs, mitigation costs, indemnity costs. What would not be covered, though, is the fine and penalties and the willful misconduct. So the key elements that we want to highlight here are the following. This policy provides a personal liability coverage to your employees. Also, it shows a good level of risk management to potential investor. It's an added value also to attract new talent due to higher regulation putting in place. And also, as soon as you are considering being listed, you need to have this kind of coverage to be covered for against securities claim. The custody solution, so the key product. Again, the example of the ship, we covered the cargo of the ship by building another layer of defense on top of the security infrastructure. And what do we cover? It's the theft, damage, and destruction of assets in hot and cold storage. And the indemnity is based on the average value of the asset at the time of the loss. So we were the first, Aon was the first in 2013 to come up with a dedicated crypto crime product. And we were also the first one to develop specific wording with specialized insurer on the London market and to build also capacities. And what are we working on today is to have a more tailor-made product, meaning that as of today, you will get indemnity. The indemnification will be paid in fiat currency. And the idea is to have the opportunity to have the payouts directly in crypto, which will enable the client to not have to take the fiat and then buy again the digital assets. So just to explain a little bit how it's working, the structure. So on the left side, you have the specie coverage, which covers only the cold storage by covering the storage media against any physical damage at the premises. And on the left side, you have the crime, which is like the broader coverage, covering cold and hot. And this covers as well internal employees and external third-party collusion. So any theft, the coverage is much more broader than what we have with specie. So what is important to understand is specie, you have more capacity but less coverage, and crime, you have higher capacity, higher coverage or broader coverage, but less capacity on the market. I don't know, Ben, if you want to add something on this.
Yeah, I think what's interesting to see on the specie side is that no one, as far as the insurance market in London is aware, which mostly provides all of the capacity for your cold storage solutions, we've never had a known loss. So if you look at how, for example, Zappo custody their solution, they actually hire out the Swiss military here in the Alps to custody and safeguard their HSMs. So really, this is kind of like a mission impossible scenario where we haven't really seen any like major breaches thus far in this space. However, this on the kind of crime side is really relevant when you're looking at MPC solutions, multi-sig solutions, and now even the custody of digital assets within smart contracts. The crime element is really going to be very, very key for future developments for custody solutions. So this is something that will always kind of have relevance in the crypto space. Yeah, and then finally, I think we wanted to just quickly touch upon the tech E&O and cyber side of our products. So really, there's a lot of kind of misconceptions when our clients or new prospects come to Aon and say, well, what's cyber insurance? A lot of people actually think cyber insurance is crime, so i.e. losing digital assets or theft of assets, but really, it's actually a breach event of your systems or software, or a loss of data, right? Or you being ransomware attacked or held for ransom from a rogue third party. That, in essence, is really what's covered by a cyber event. So if you run a DeFi exchange, probably not, this won't really relate to you, but if you're running a marketplace, an exchange, a platform where you hold customer data, where you do have some form of like centralized like data depositories, then this could actually really hit you. The one element that is relevant to the DeFi element is obviously the cyber extortion. We do see DeFi protocols get hacked and then extorted to drop legal claims against the hackers for like 80% of assets and funds returned. So we are starting to see that pop up more in the decentralized space, but otherwise this is really core for anyone who has any kind of like centralized data management in their systems. On the flip side, tech and professional indemnity. This is really there for the failure of conducting a technology product or service. So if you have a wallet as a service company, you're creating smart contract software for other companies, even like tokens or any type of kind of DApp or API that you're integrating with another piece of software, a lot of companies will look to kind of purchase this policy because it's just a direct defense cost against your clients or investors suing you for wrongful act where your technology can fail and can lead to business interruption and loss of assets, right? So this is kind of very, very crucial when it comes to the crypto space for sure. I wanted to take you through an example of something that we've recently just built on for a proof of stake validator. So basically, staking as a service providers have got more and more common in the space. And since the Shanghai update, where you can now actually get your Ethereum back out through the blockchain and through that staking process, everyone seems to be very bullish on the space. So one of the things we wanted to look at here is actually what causes a slashing policy and what are the slashing loss events within this policy, and how does a policy actually trigger when you're looking at a tech E&O policy. So the two ways you can really be slashed and lose money is an inactivity leak, right? So when the node is not active for a period of time, and then the network will actually penalize you per hour of what you're losing. And then the most common way, and probably the most costly way, is actually double signing, right? So for example, if your node was active whilst you were testing another node, or you're upgrading another node, and you forget to turn off your live node, then you can actually double sign on a block, and a slasher will come through the Ethereum blockchain and slash you. So really, what most of these staking as a service providers are scared of is not so much the uncorrelated risk, but the correlated risk. So what do I mean by correlated slashing risk? That's basically when you're using one client type. So there's 4 prominent client types in staking as a service providers. And if there is error with the correlated client type across all staking as a service validators, we could see a huge hit to the Ethereum blockchain. Okay, so this is really what we are insuring against also. So here are the slashing loss event claims. So slashing penalties incurred by the company resulting from a wrongful act. So really, that could be an inactivity leak for hours and hours upon end. We've just seen one in the market, so you guys can have a look at that online. And double signing and that can be from a technology failure or a wrongful act or an internal employee making a mistake. And then also, lastly, with all tech E&O deals, general damage and defense costs, so that's your clients or your investors who stake money in one of your nodes will come and sue you. These are your defense costs for arguing your case in a court. So yeah, this is just a really good example of how a claims process would work for a Web3 tech E&O deal. Okay, we wanted to also talk about some of the more innovative solutions that we have ongoing at Aon. We're going to touch on a couple here. But first, yeah, I wanted to talk you through Aon Web3 Protect, which is almost like a brand new solution that's currently being built internally. And it's really looking at Web3 software risk. So as some of you might be aware, the insurance market has not looked at Web3 software risk at all, really. And it's largely down to like the unregulated insurance providers looking at providing like potentially crime for smart contract loss. But really where we feel the biggest market need is actually providing tech E&O for smart contracts, the liability side of the insurance. And really we see a lot of the excellence held by smart contract auditors and also the incident response management software that always is tracking smart contract activity. How are the oracles performing? Are there any funky gas fees associated with that smart contract? You know, are there any dodgy withdrawals and deposits that make it known that a breach event or a loss event could occur? So all of these things we're starting to track. We're starting to get our analysts, you know, to start looking and pricing this type of risk, and ultimately using the data from the smart contract auditor with our tech team and our actuarial experience to deliver a solution that will cover the theft of digital assets from a smart contract wallet, in addition to the actual liability of providing that type of software to clients and investors too. So ultimately, Web3 Protect will encompass the slashing and staking element, which is live, and also the Web3 software risk element, which is massive at the moment. And you think the expansion of the metaverse and other types of layer 2s, and everyone's racing to this like mecca of a multi-chain approach, then this is going to be really essential in building trust and scalability and, you know, institutional adoption in this space. And then lastly, I wanted to also talk about what we're doing in Bermuda with a company called Names. So Names is a really interesting company. They're almost like a Lloyd's of London marketplace, but built on top of the Ethereum blockchain. And the idea is that investors, professional investors, institutions, can come in and capitalize a sell with on Names and become their own insurance vehicle. They can decide, hey, we're going to capitalize, 50 ETH in one cell, and we want to start insuring smart contract risk, or we want to do depegging of a stablecoin, for example. So it basically gives you a very innovative way as a crypto investor to have a non-correlated investment, which what I mean by that is it's not correlated to a financial market or a price market. It's actually investing in a very specific risk element of the Web3 space. So you bring in the forward-thinking insurers and capital providers, and then the Web3 clients and prospects, and you have a marketplace that can actually trade risk, underwrite risk, and also reinsure risk that's denominated in a potential cryptocurrency. So that it's built on top of Ethereum, right? So you've got wrapped Bitcoin, Ethereum, USDC are probably going to be the most common assets. But you can also access new capacity that's not available to you in the traditional insurance world from native crypto investors, but also VCs, PE firms, hedge funds that are looking to get into that space. And what the on-chain element of it is the policy will be created on-chain and issued through on-chain. The premium payments will be done through Ethereum, and also the claim payouts will be done through Ethereum. So at the moment in the insurance industry, these are done with retail banks, and it takes ages and it's very expensive, which won't be a shock or a horror to you guys. So what we're really trying to do is streamline the process, make it more efficient, make it quicker. And this is our first test product that we're going to be launching in a couple of months, or in a couple of weeks even from now, which is super exciting. So lastly, Laurent and I wanted to focus on the new risk environment where we kind of feel, what is kind of like interesting in the Web3 space and some of the risks that we're going to be looking at on and how we kind of counter or try and provide insurance solutions for. So first of all, I wanted to start on AI. Everyone's speaking about AI at the moment, and a lot of the creators of ChatGPT and other types of like open source AI are really, really scared about what could potentially happen to civilization, to people's jobs, etc. But I almost see it as a massive risk to blockchain and cryptographic security. I saw a tweet the other day that was basically saying, ChatGPT had already identified issues within a piece of Solidity code from a smart contract in 2014. Well, obviously, they were quite rudimentary back then. But if a piece of AI can already look at code and identify holes in it with machine learning in 4 to 5 years' time, what do you think it could do to the governing smart contract of Bitcoin or Ethereum or any other kind of chain or network that we work on? It's actually terrifying. So what can we do to enhance our security layers on chain? I think is super important. And what type of kind of warranties or an insurance can we give to these type of networks to basically battle the threat from AI? But on the flip side, can blockchain provide the necessary safeguards to moderate the power of AI? And what do I mean by that? Well, could we have AI, being governed by cryptographic keys? Could we have them sharded? Could we start decentralizing the power of AI? And this has been talked about by some industry experts at the moment. We're not sure exactly how that would work yet, but I think there's definitely an opportunity to use blockchain in some way, shape, or form to perform that function. So Laurent, you want to talk about the metaverse?
Yep. So very briefly on metaverse, it's still an underdeveloped ecosystem with a lot of outstanding question and question marks. So let's consider like someone steal your identity tokens and start impersonating you on the metaverse, committing like a fraudulent act or criminal act. How can you prove that it's not you? How also the technology failure side, who's responsible in case of technology failure and you lose your assets or your data has been stolen and like published on the internet and so on? Who will be responsible also between like the centralized and the decentralized people? So meaning the centralized like Meta and the decentralized provider. Who will have the ownership of the risk and who will be liable in case of, mainly technology failure or identity theft? Those questions are still pending and we don't have the answer so far. So that's why we will focus on for the next couple of years, I think. I don't know, Ben, if you want to add something on metaverse.
Yeah, it's so nascent at the moment. We just don't know how it will all work. But it's constantly in our scope for future development. And then finally, everyone's talking about tokenized real-world assets at the moment. Every tier 1 bank we speak to, asset manager, hedge fund, they're all looking to tokenize real-world assets right now. So that's like the main kind of drive. But really, what we're thinking about at Aeon is, what's the proof of reality for the underlying assets? So it's all well and good trading these digital securities or tokenized like property, for example. But who's doing the check on the other side in the real world? And then who's sending that data from almost like a Web2 to Web3 system where traders that have the digitized tokens can know for sure, for real, that the underlying asset is true, there's no outstanding liability claims on the asset, and they have the adequate insurances in place. So there almost is this kind of like divide where we're building the infrastructure, the correct infrastructure to start trading these types of assets, but really are we doing the necessary due diligence and data transfer from 2 to 3 to actually provide like a stamp of approval, right? That the assets you are trading and holding and earning yield from are what they say they are. And we're also seeing this in the NFT space, especially when we look at like patent and IP infringements. Artists or creators on OpenSea can create pretty much whatever they want. It's an open market, which is great. But then we're also seeing that there's some like IP infringements from major brands that some of these artists are issuing and selling for profit. So from the end investor perspective, if you buy something that's fake or has a certain like IP infringement to it or copyright infringement, then that's a certain risk that you don't really want to be taking on. And then we've also got like the physical loss of the underlying asset as well. We've seen this in a few cases where tokenized real-world art has actually been lost or misplaced with art couriers or through transit, and it's affected the investors. And we've had discussions with our clients about this as well. So really, this is where we see a big hole in the market on the proof of reality side, as well as ensuring the virtual assets and the actual the underpinning technology. So this is a big focus area for Aon too. So I think almost, Lauren, with that, we're pretty much there with concluding our initial presentation and workshop. Do you have any closing remarks you'd like to make?
So I think what the key elements are is, I should mention like three of them. First, I think we understand your activity. We are the most advanced broker in the space. So we are here to support your development and also helping you to build a stronger risk management process. And also, the last thing is come and see us at our stand. That's a conclusion.
Yeah, and as you develop, and as this Web3 risk environment develops, you might look at the products you have and think, we don't need any of them. These are kind of nonsensical for us to purchase. But as you get into the crazy amount of development that we're seeing, especially in the open source space right now, it's always worth just having a look at your risk management process, having a look at what type of risk mitigation processes you have internally. So when a big seismic event happens that might affect your business, or you have like an uncorrelated loss, just think about how you're positioned. If you're talking to your investors or your clients, how you're positioned to mitigate the impact on your business. And it's always something to think about as well. So with that, I will leave it there and obviously open it out to any questions that the audience may have. Thank you.
I have the mic for questions. Thank you.
Thank you. So just one question. When you said data loss, referring to metaverse, going back to a decentralized exchange where the user, the retail user, the new adopter, like 98% probably worldwide that don't have technical knowledge in crypto, what happens if they lose their mnemonics?
Yeah, so do you mean from a metaverse or DEX perspective?
I mean from a DEX perspective, because a metaverse I understood and it makes sense. Stealing identity, it's simple. But I mean exactly referring from a DEX, because we have this saying, your keys, your funds. What happens if I actually lose my mnemonics? So I forget my phrase. Do I get the coverage?
Yeah, so really good question. So it kind of goes back to that cyber techie side we had up. So on the cyber side, I mentioned it's kind of more there for the centralized actors to actually store data, right? But also like a centralized exchange, like a Coinbase or a Kraken, for example, who host their own hot wallets. They're never your keys, right? But on a DEX, the type of insurance that DEXs can purchase is a technology error and omissions policy, which is the other side, which ensures that the technology works correctly. So from a DEX perspective, from my opinion, the big risk is that the wallet that you connect with is faulty, and then there's a breach through that, but that's not the DEX's fault, is it? But the big technology risk is actually the DEX fails, and it redirects your assets in a wrong way, or there's some sort of issue where you just can't trade on it anymore, which can cause business interruption claims. But really, it's not really a cyber loss because there's no data being lost, unless the order book is centralized. And I've seen that sometimes on DEXs, that you can have centralized order books, but it's not that common.
Okay, I get it. Second question. Regarding different blockchains, we talked here about Ethereum, and I think you mentioned another one, I don't remember. The Bitcoin, you meant something about Bitcoin, Ethereum, and so on. But today we have a multitude of blockchains, and each new blockchain says it's the fastest, it's the best ever. Oh, it's a saying. Now, what happens if a blockchain fails? So I have my assets in a blockchain, the blockchain fails. Like I don't get access to my funds for 90 days. Do I get the coverage for that?
At the moment, no. So it's interesting because most insurance globally excludes war, right? Some shipping policies include it, but mostly war is excluded because it's like a cataclysmic disaster event and everything's off the cards. No rules of society apply no more, right? It's the same with that. If Ethereum or Bitcoin goes down, it's endgame situation. Insurers aren't going to pick that up because that's just a cat event that would just break everything. And we probably wouldn't be here anymore and we'd be doing something else. We'd be working in fintech. Okay. Terrifying.
Okay, last question.
Yeah.
Last question and I will finish because it was a very interesting topic. I'm actually, I'm developing a project on the Multiverse X blockchain of our network, and we're working on a solution to bring some peace of mind to people that are new adopters and lose their mnemonics or have this afraid of blockchain fault. Yeah. And the final question, what happens when users go into phishing websites? Is there a coverage or will there be a coverage in the future for such a product?
So users from an exchange would get phished and then they would do... Yeah, so the way it would work is a crypto exchange would always have a crime policy. So, but you would need to look at what we call the excess or retention. So like you guys would have dealt with this on your car insurance or whatever. So, you know, if it's like $1 million in excess, like the customer would need to lose like a significant amount. So what happens, and this is the industry practice, is that exchanges will normally indemnify you if you are phished. Good exchanges will normally do that without claiming on their insurance. We don't have a policy yet, which we call like a per user policy with exchanges that's really like scaled. And the reason is like policy management is super hard. You need to issue like hundreds of thousands of even millions of different policies per user. And it costs a lot of money to track a claim. So if it's just small amounts of phishing, normally the exchange will cover it. And if it happens loads of times, then it's kind of like your fault in a way. So that's usually what happens. But account takeover insurance might become a thing in the future. It just isn't at the moment. Yeah. Any other questions? Oh, okay.
Thank you for a presentation. From a DApp or protocol perspective, there are a lot of hacks and exploits happening. Last year was more breaches. Recently, we are seeing a lot of flash loan attacks. Yeah. Can you cover everything that can potentially happen to a protocol, even if they don't know in advance different things? For example, flash loans, drained wallets, every bug that they might have on their smart contract that could be exploited by attackers?
Potentially. So the only caveat to that is that it's issued by known individuals or recognized individuals or an entity. So with insurance, it's like if we were to try and insure Aave or compounds, no one owns Aave or compound really. You have Aave companies building infrastructure on Aave, but it really has like a DAO governance structure, which is kind of hard for very, very regulated insurance companies to come in because it's kind of hard to identify domicile, territory, regulations, etc. But if Coinbase, for example, were to issue smart contracts or dApps or APIs that would connect within the Web3 space, then absolutely, that's easily insurable. You just need to have a business or notable individuals behind it where you can be identified, go through the audit process, and go through like an incident response management process. Then yes, in theory, that could be, but you would just need to show that your technology is safe and sound, and that's really the process you'd have to go through.
To a DAO, or it should be registered?
At the moment, DAOs, really interesting. So a lot of them will be in like Cayman, BVI. We see a lot in like smaller jurisdictions. And a lot of them are like self-insured or have captive solutions at the moment. They can't really access the big insurance markets for the reasons I've just mentioned. So I think as we get better regulations and governance on how DAOs work, and I know like Wyoming in the US is starting to like incept and domicile these types of DAOs, then we might have greater confidence. But we just don't see a lot of demand in Aon for insuring DAOs. I don't know why. Maybe they're still in their infancy, but we don't get a lot of interest from DAO. The DAOs want their assets to be covered from a crime perspective, from a custody perspective, not so much like covering the business liability of a DAO. Yeah.
Hi, Benjamin. How you doing?
Hey.
Quick question. So insurance companies obviously have a lot of liquidity and they might buy premium bonds or something safe. How far away do you think insurance businesses are from participating in DeFi from a liquidity perspective?
Yeah, so we do make a lot of money in like premium insurance trusts. So that's when we hold premiums on behalf of clients and then before passing them to markets. Those are like AAA rated securities. And that's the thing, it's like, so our fiduciary responsibilities with our treasury is to have almost like an A-rated type of security, right? So I think when if Web3 has better protections, insurances in place, that that you can be made whole exactly by staking your assets or at least getting into some sort of loan agreement on chain, and it's insured, backed, and done by a regulated financial institution, then there's definitely a case to be made there. But all of those things need to be there. It needs to be rated, issued by a financial institution, and have warranties and insurances backed behind it. That's the gap at the moment. That's preventing big tier ones, big insurers, big pension funds depositing more cash into the space. It's because it's a very, very risk-on activity, which sometimes is actually not allowed by the different regulators.
Yeah, I think we're all here because we hope that's the direction they're going. But I guess into your mind and your perspective, how far away do you think?
At least 5 to 10 years until the US determine how they want that place to be. Because what we find is like the OCC or other regulators will have a top-down approach. So if you're domiciled, if you're a tier 1 bank, you ultimately answer to the US regulator, and then all of your other activities globally will be determined by that. So until we have greater clarity by international agencies and local regulators, I still think we're quite far off.
Well, thank you so much, Benjamin.
Okay.